Before we dive in, please remember that this video is for educational purposes only and should not be considered financial advice. I am not a licensed financial advisor, mortgage broker, or real estate agent. The real estate market and lending regulations are complex and vary by state. Always consult with qualified, licensed professionals before making any financial decisions regarding a home purchase. You found it. The perfect house. It has the open concept kitchen you've been dreaming of, the backyard for the dog, it's in the right school district. And then you see the numbers. You run the mortgage calculation and it's a gut punch. That monthly payment isn't just high. It's a crushing, dream-killing number that makes you feel like homeownership is completely out of reach. That feeling of sticker shock of being priced out of your own future is something millions of Americans are facing right now. But what if I told you there's a way to get into that exact same house, but with a monthly payment that's hundreds, maybe even over $1,000 cheaper for the first 2 years? What if you could get an interest rate a full 2% lower than what the bank is advertising? And here's the kicker. What if the person selling you the house paid tens of thousands of dollars out of their own pocket to make it happen for you? It sounds like a fantasy, like some kind of secret loophole for the ultra-wealthy. But it's not. It's a powerful and surprisingly common mortgage strategy called a 2-to-1 buy-down. And by the end of this detailed guide, you will understand exactly what it is, how it works, the critical pros and cons, how to know if it's the right move for you, and most importantly, how to negotiate one with a seller to save an incredible amount of money. We're going to demystify this entire process, so you can walk into a negotiation with the confidence of a seasoned pro. This isn't just theory. I've seen this strategy completely change the game for buyers who were on the verge of giving up. I saw a young couple in Texas who were looking at a monthly payment of nearly $4,000. They were stretching, they were stressed, and they were about to walk away from their dream home. Instead, they negotiated a 2-to-1 buy-down. For the first year, their payment dropped by over $700 a month. That's real money. That's breathing room. It's the difference between being house poor and actually enjoying your new home. So let's pull back the curtain. What exactly is a 2-to-1 buy-down? Think of it like a temporary discount on your mortgage paid for by someone else, usually the seller or the home builder. It's designed to ease you into your full mortgage payment over time. The 2-to-1 part of the name is the key. It describes how your interest rate is reduced for the first 2 years of the loan. In year 1, your interest rate is 2 percentage points lower than the note rate. In year 2, your interest rate is 1 percentage point lower than the note rate. And in year 3, and for the rest of the loan, your rate adjusts to the original, full note rate. It's like a financial on-ramp to your mortgage. Instead of getting thrown onto the highway at full speed, you get a long, comfortable ramp to get adjusted. Now, you're probably asking the most important question. Where does this money come from? It's not magic. The bank isn't just giving you a gift. This is where the seller comes in. As part of the negotiation for the house, the seller agrees to deposit a lump sum of cash into an escrow account held by your lender. That cash is the exact amount needed to cover the difference between your reduced monthly payments and what the full payment would have been for those first 2 years. So, every month for 2 years you make your smaller discounted payment. Then the lender pulls the extra cash from that special escrow account the seller funded, combines it with your payment, and pays the mortgage in full. The lender is always made whole. The seller makes their property more attractive and affordable to you. And you get a significantly lower payment for the first 24 months of homeownership, which are often the most financially tight. Let's put some real numbers to this because that's where the light bulb really goes on. Imagine you're buying a house and your loan amount is $400,000. The current market interest rate you qualify for on a 30-year fixed mortgage is 7%. Let's run the numbers. A $400,000 loan at 7% gives you a principal and interest payment of roughly $2,661 a month. For many people, that's a tough pill to swallow. Now let's apply the 2-to-1 buy-down strategy. For the entire first year, all 12 months, your interest rate isn't 7%. It's 2% lower. So you're paying just 5%. At 5%, your monthly payment on that same $400,000 loan drops to just $2,147. That is a savings of $514 every single month. Over the course of that first year, you've kept over $6,100 in your pocket. That's money for new furniture, for building up your emergency fund, or just for reducing financial stress. Now for year 2, your rate goes up, but it's still discounted. It's 1% lower than the full rate, so you'll be paying 6%. Your monthly payment is now $2,398. You're still saving $263 a month compared to the full payment. That's another $3,156 in savings for year 2. Then in year 3, the buy-down period ends, and your payment adjusts to the full, original 7% rate of $2,661, and it stays there for the rest of the loan's life. So what did this incredible savings cost you? Nothing. The cost is paid entirely by the seller. Let's calculate it. The total savings for you over those 2 years is the $6,168 from year 1, plus the $3,156 from year 2. That comes out to $9,324. That is the amount the seller would have to deposit into that escrow account at closing to make this happen for you. Think about that from a negotiation standpoint. Instead of asking a seller to drop their price by $10,000, which they might be reluctant to do because it directly lowers the sale price, you're asking them for a seller concession of just over $9,000 to fund the buy-down. For them, it feels different. For you, the immediate cash flow impact is massive. A $10,000 price reduction on a $400,000 loan only saves you about $60 a month. The buy-down saves you over $500 a month in that critical first year. It's not even in the same league. This is why 2-to-1 buy-downs become incredibly popular in housing markets where interest rates are rising or have settled at a higher level. When affordability becomes the #1 obstacle for buyers, sellers and builders need to get creative. They can either slash their prices across the board, or they can offer these targeted concessions that make a huge psychological and practical difference for a buyer. It's a powerful tool that transforms a home that feels financially impossible into one that feels manageable, giving you the time to get a raise, grow your income, or potentially refinance your loan if and when rates drop in the future. So this all sounds amazing, right? A lower payment paid for by the seller. It almost seems too good to be true. And that's the right question to be asking. Because while this is a fantastic strategy for the right person in the right situation, it is absolutely not a magic bullet for everyone. There are specific risks, potential downsides, and crucial details that lenders and real estate agents sometimes gloss over. Who is this really for? And more importantly, what are the hidden traps you need to be aware of before you even think about signing on the dotted line? We're going to break all of that down next. So let's start with the ideal candidate, the person this product was practically designed for. Picture someone whose income is on a clear upward trajectory. Think of a medical resident who knows their salary will double in 2 years, or a software engineer who just landed a junior role, but is on a fast track for promotion, or even a salesperson whose commission checks are small now, but are projected to grow substantially as they build their client base. For these individuals, the 2-to-1 buy-down acts as a financial on-ramp. It allows them to afford the house they want today, based on the income they know they'll have tomorrow. The lower payment in year 1 provides critical breathing room, while their earnings are still catching up to their potential. By the time the full mortgage payment kicks in during year 3, their bigger paychecks can comfortably handle it. It bridges the gap between their current reality and their future financial stability. Another classic profile is the family planner. Imagine a young couple. They found their dream home in a great school district, but one of them is on parental leave or has temporarily switched to part-time work to care for a new baby. Their household income is temporarily reduced, making that full mortgage payment feel tight, maybe even impossible. A 2-to-1 buy-down can be a lifesaver. It dramatically lowers their housing costs for that crucial first year, and even the second, giving them financial flexibility when they need it most. By year 3, the parent is often back to working full-time, their income is restored, and the standard mortgage payment is no longer a strain. It's a tool that aligns the mortgage payment with the predictable ebbs and flows of a growing family's income. And then there's the third, and right now the most common candidate, the strategic rate watcher. This is someone who can, on paper, afford the full mortgage payment at today's high interest rates. They have the income, they have the down payment, but they are understandably hesitant to lock in a 7 or 8% interest rate for the next 30 years. Just feels wrong. For this buyer, the 2-to-1 buy-down isn't about affordability. It's about strategy. It's a calculated gamble. They get a significant payment reduction for 2 full years, effectively renting money at a cheaper rate. The entire time they are watching the market like a hawk, waiting and hoping for interest rates to drop. Their plan isn't to pay the full note rate in year 3. Their plan is to refinance into a new, lower rate loan before that 3rd year ever begins. This strategy gives them immediate monthly savings while preserving the opportunity to secure a better long-term deal down the road. It's a bridge not to a higher income, but to a hopefully lower rate future. But here's where we have to get serious, because even if you see yourself perfectly in one of those descriptions, there are critical traps hidden in the fine print. And the first one is the biggest, most common shock for potential buyers. It's called the qualification hurdle. You see that beautiful low year one payment and think, great, I can definitely afford that. But the bank doesn't see it that way. Lenders will not, I repeat, will not qualify you for the loan based on that artificially low first-year interest rate. They qualify you based on the full undiscounted note rate. So, if the loan's actual rate is 7%, you must prove you can afford the payment at 7%, even though you'll be paying at 5% for the first 12 months. Why? Because the lender has to be sure you can handle the worst-case scenario. They need to know that if you can't refinance and your income doesn't go up as planned, you won't default on the loan when the payment shock hits in year 3. This single rule disqualifies a huge number of people who get excited about the Buydown's marketing. It isn't a tool to help you buy a more expensive house than you can actually afford. It's a tool to change the payment structure on a house you can already qualify for. The second major trap is the one I just hinted at, the refinancing gamble. This is especially dangerous for the strategic rate watcher we talked about. The entire strategy hinges on the assumption that you'll be able to refinance into a better loan within 2 years. But what if you can't? What if interest rates don't go down? What if they go up even further? There is absolutely no guarantee that the rate environment will be better in 24 months. You are making a bet on the future of the global economy. Furthermore, it's not just about market rates. What if your personal financial situation changes? What if you change jobs and have a lower salary? What if your credit score takes a hit because of unexpected medical bills? Any of these things could make it impossible for you to qualify for a refinance, even if rates do drop. If that happens, you're stuck. The training wheels come off, and you are now responsible for the full, original, high-interest mortgage payment for the remaining 28 years. The Buydown wasn't a bridge to a better future. It was just a temporary discount before the real long-term pain begins. Next up is trap number 3, and it's a subtle one. The seller concession illusion. In most 2-to-1 buydowns, the money for the buydown comes from the seller as a credit at closing. On the surface, this feels like free money. The seller is paying to lower your interest rate. But is it really free? Let's think about this. If a seller is willing to give you, say, $10,000 in credit for a buydown, it's highly likely they would have also been willing to simply reduce the price of the house by $10,000. You have to ask yourself, which is better? Let's run a quick comparison. A $10,000 buydown gives you a temporary 2-year reduction in your monthly payment. After that, it's gone. A $10,000 price reduction, on the other hand, lowers the principal balance of your loan for its entire 30-year life. This means you're borrowing less money, paying less total interest over 3 decades, and your property taxes, which are based on the sale price, might be slightly lower every single year. The immediate cash flow from the buydown is tempting, but the long-term savings from a price reduction are often mathematically superior. The buydown's value is front-loaded and temporary. A price cut's value is permanent. Don't let the shiny object of a low initial payment distract you from the more powerful, long-term benefit of a lower purchase price. Finally, there's a common fear that acts as a trap of its own. The belief that you'll forfeit the buydown funds if you move or refinance early. Let's say the seller paid $8,000 into an escrow account to fund your buydown. Then, 14 months into your loan, interest rates plummet and you decide to refinance. You've only used a portion of that $8,000. What happens to the rest? Many people assume the lender just keeps it, and the money vanishes into thin air. This is almost always false. With nearly all standard 2-to-1 buydown agreements, any unused funds in that escrow account are applied directly to your principal balance when you pay off the loan, either through a sale or a refinance. So, if there's $3,500 left in the account, your loan payoff amount is reduced by $3,500. You don't lose the money. It's a critical detail to confirm in your loan documents, but it's a huge myth-buster. Knowing this completely changes the calculation. It means you can aggressively pursue a refinance the moment it makes sense, without worrying that you're throwing away the seller's contribution. The risk isn't that you lose the money, the risk is being stuck with a high rate if you can't refinance. So we've identified who this works for and the major pitfalls to avoid. You have to qualify at the full rate. You have to understand the refi gamble. And you need to weigh the pros and cons against a simple price reduction. So now that you know the players and the pitfalls, how do you actually run the numbers to see if this makes sense for your specific situation? What's the exact formula to compare a buy down against a price cut? And how do you calculate the break-even point to know if it's truly worth it? That's precisely what we're crunching next. Alright, let's get our hands dirty with the actual math. This is where the rubber meets the road, and you'll see exactly how a 2-to-1 buy down impacts your wallet, both today and 10 years from now. To do this, we need a real-world scenario. Let's imagine you've found a house listed for $500,000. You're a solid buyer, so you're putting 20% down, which is $100,000. This means your loan amount is $400,000. Now, let's say the current market interest rate for a 30-year fixed mortgage is a flat 7%. We'll use this as our baseline. If you took out a standard mortgage for $400,000 at 7%, your monthly principal and interest payment would be about $2,661. Remember that number, 2661. That's your full normal payment for the next 30 years. But the seller, eager to make a deal, offers you a 2-to-1 buy down. So what happens now? In year 1, your interest rate isn't 7%. It's 2 points lower, so it's 5%. Your monthly payment on that same $400,000 loan, but at 5%, drops to just $2,147. That's a monthly savings of $514. $514 every single month for the first year. That's cash in your pocket that can go towards new furniture, emergency savings, or just breathing room as you settle into your new home. In year 2, the rate steps up. It's not the full 7% yet, but it's 1 point lower at 6%. Your new monthly payment becomes $2,398. You're still saving money compared to the full payment. Your monthly savings in the second year are $263. Still a significant amount. Then, starting in year 3 and for the rest of the loan, your rate locks in at the full 7%, and your payment becomes that original $2,661. So, where does the money for these savings actually come from? It's not magic. It comes from a lump sum of cash paid up front, usually by the seller or builder. Let's calculate the exact cost of this buy down. For year 1, the total savings were $514 a month times 12 months, which equals $6,168. For year 2, the savings were $263 a month times 12 months, which equals $3,156. Add those two amounts together. The total cost of this 2-to-1 buy down is $9,324. This is the amount the seller deposits into a special escrow account for you at closing. Your lender then pulls from this account each month to supplement your lower payment. You pay your part, the fund pays the rest, and the lender gets their full payment. It's a clean, simple mechanism. Now, this is the most important part of the entire video. This is the question that separates a smart buyer from everyone else. You see that buy down cost, that $9,324, and you should immediately think, wait a minute. Instead of this fancy buy down, why don't I just ask the seller to drop the price of the house by that same amount? This is the ultimate showdown. The buy down versus the price cut. Let's run the numbers side by side. In one corner, we have the buy down buyer. They buy the house for the full $500,000, get the $9,324 seller credit, and enjoy those super low payments for 2 years. In the other corner, we have the price cut buyer. They negotiate a price reduction equal to the cost of the buy down. So, they buy the same house not for $500,000, but for $490,676. The price cut buyer still puts 20% down, but 20% of a lower price is a slightly smaller down payment. Their loan amount is now $392,541. They don't get a temporary buy down, so their interest rate is 7% from day one. So what's their monthly payment? On their slightly smaller loan, their principal and interest payment at 7% is $2,612. Let's compare. The original payment was $2,661. The new payment after the price cut is $2,612. That's a permanent monthly savings of $49. It's not the massive $500 savings of the buy down, but it's forever. For all 360 months of the loan, you are paying $49 less. So which is better? A huge temporary discount or a small permanent one? The buy down buyer saves a total of $9,324 over the first 2 years. The price cut buyer in those same 2 years saves $49 a month. That's only $1,176. Looking only at the first 2 years, the buy down is the hands down winner. It's not even close. You have over $8,000 more in your pocket with the buydown during that initial period. This is the cash flow argument. If your primary concern is maximizing your available cash in the short term, the buydown is incredibly powerful. But the story doesn't end at month 24. Starting in month 25, the situation flips entirely. The buydown buyer's payment jumps up to the full $2,661. Meanwhile, the price cut buyer keeps cruising along, paying their lower $2,612. From this point forward, the price cut buyer is now saving $49 every single month that the buydown buyer isn't. This brings us to the most critical calculation of all, the break-even point. This is the exact moment in time when the small steady savings from the price cut finally catch up to and overtake the big upfront savings from the buydown. Let's figure it out. After 2 years, the buydown buyer was ahead by $8,148 in total savings. But from now on, the price cut buyer starts closing that gap by $49 each month. So, how many months does it take for that $49 to eat away the $8,000 lead? We just divide. $8,148 divided by $49 per month equals 166 months. That's about 13.8 years. So, the total break-even point is the initial 2 years of the buydown plus those 13.8 years. It all adds up to roughly 15.8 years. Let that sink in. If you plan to sell the house or refinance your mortgage anytime within the first 16 years, the 2-to-1 buydown was the mathematically superior choice. You came out ahead financially. You had more cash in your pocket. However, if you are 100% certain you're going to stay in that house with that same mortgage for 17, 20, or 30 years, then the permanent price reduction is the long-term winner. Over the full 30 years, those small $49 savings add up to over $17,000, far more than the $9,000 saved by the buydown. Plus, your loan was smaller from the start, meaning you're building equity slightly faster and paying less total interest over the life of the loan. This is the core dilemma. It forces you to be honest with yourself about your future plans. Are you buying a starter home that you'll likely outgrow in 5 to 7 years? Or are you buying your forever home? Are you anticipating that interest rates will drop significantly in the next few years, making a refinance almost certain? If you plan to refinance, the buydown is an absolute no-brainer. You get the massive savings for 2 years, and then you refinance into a new lower-rate loan anyway, completely wiping out the long-term advantage of the price cut. You get the best of both worlds. This break-even analysis is the key. It moves the conversation from a gut feeling to a data-driven decision. The choice between a buydown and a price cut isn't about which one is good or bad. It's about which one is strategically aligned with your personal timeline and financial goals. Now you have the formula to figure it out for yourself. So, who is this strategy perfectly aligned for? Who are the people that stand to gain the most from this unique financial tool? It's not a one-size-fits-all solution, but for a few specific types of homebuyers, it can be a game-changer, turning an impossible situation into a closed deal. Let's break down the ideal candidates, moving from theory to real-world scenarios. First, and perhaps most obviously, is the buyer with anticipated income growth. Think about young professionals, medical residents, lawyers who are about to make partner, or entrepreneurs in the early stages of a profitable business. Let's create a hypothetical couple. Meet Alex and Jamie. Alex just finished a grueling residency and has accepted a position as a full-time physician at a hospital, but that job doesn't start for another 6 months. Jamie has a stable, good-paying job, but on their own, it's not quite enough to comfortably afford the payment on the house they need in their new city. They've found the perfect home for $500,000. With 20% down, their loan is $400,000. The current market interest rate is a stubborn 7%. Their principal and interest payment would be about $2,660 a month. Add in taxes and insurance, and they're looking at a total monthly pity of around $3,400. On Jamie's salary alone, that is tight. It's we're eating ramen for the next 6 months tight. They could qualify, but they'd have zero breathing room. Now let's introduce a seller-paid 2-to-1 buydown. The seller, eager to close the deal, agrees to fund the buydown. In year 1, Alex and Jamie's interest rate isn't 7%, it's 5%. Their principal and interest payment drops to about $2,147. Their total monthly payment is now closer to $2,900. That $500 a month in savings is the difference between financial anxiety and stability. It's the difference between scraping by and being able to comfortably set up their new home. In year 2, the rate adjusts to 6%. The payment goes up to about $2,400 for principal and interest. Still a significant savings. By the time year 3 rolls around and the rate normalizes to the full 7%, Alex will have been in their new, high-paying job for a year and a half. Their household income has dramatically increased. That full $3,400 payment that once seemed daunting is now easily manageable. The Buydown acted as a financial bridge. It didn't just get them into a house. It got them into the right house at the right time, perfectly aligning with the trajectory of their careers and income. For them, a simple price reduction wouldn't have solved the core problem: immediate monthly cash flow. The Buydown was the precision tool they needed. The second ideal candidate is what I call the refinance optimist. This is a buyer who is well qualified, financially savvy, and has a strong conviction that interest rates are going to fall within the next 12 to 24 months. This buyer looks at the current 7% rate and thinks, "This is temporary. I'm not going to be paying this for 30 years. They are already planning to refinance as soon as rates drop to a level they find more palatable. For this type of buyer, the 2-to-1 Buydown is less of a bridge and more of a low-cost insurance policy with a huge potential upside. They can afford the full 7% payment from day one. That's not the issue. The issue is that they hate the idea of paying that much even for a short time. The Buydown gives them a guaranteed discount for 2 years, while they wait for the market to turn in their favor. Let's follow their logic. They take the 2-to-1 Buydown. For 2 years, they enjoy significantly lower payments, saving thousands of dollars in interest. Now, 2 scenarios can unfold. Scenario A. They are correct. In 18 months, the market shifts and mortgage rates drop to 5.5%. Perfect. They refinance their loan, pay off the original mortgage, and lock in a new low fixed rate for the next 30 years. In this case, the Buydown was a massive success. It saved them money while they waited for the perfect moment to strike. But what about scenario B? What if they're wrong? What if, after 2 years, rates haven't dropped? What if they've stayed at 7% or worse, have gone up to 8%? Well, in that case, the refinance optimist simply stays in their original loan at the 7% note rate. And here's the crucial part. They haven't lost anything. They were qualified and prepared to pay that 7% rate from the very beginning. The Buydown still provided them with 2 full years of discounted payments, money in their pocket that they would not have had otherwise. It's a strategy where they win if rates go down, and they still come out ahead even if rates stay the same or go up. It removes some of the sting from a high-rate environment and gives the buyer a sense of control, a tangible benefit while they play the waiting game. Now let's flip the script entirely. So far, we've only talked about how a Buydown benefits the buyer. But one of the most powerful and underutilized aspects of the 2-to-1 Buydown is its role as a strategic tool for the seller. Imagine a seller. Let's call her Maria. Maria is relocating for a job and needs to sell her house. It's a great house, but the market has softened. It's been listed for 45 days, and all she's getting are a few lowball offers. Her listing price is $600,000. Buyers are balking at the monthly payment that comes with the current interest rates. Her agent tells her she might need to drop the price by $25,000 to get it sold. That's a painful $25,000 hit to her net proceeds. But Maria is smart. Instead of a blunt price drop, she decides to offer a seller concession to fund a 2-to-1 Buydown for a qualified buyer. Let's run the numbers. On a $500,000 loan amount, the cost of that Buydown might be around $11,000. Think about that. She can either drop the price by $25,000, or she can offer an $11,000 concession. By choosing the Buydown, she potentially saves herself $14,000. But the financial benefit for Maria is only half the story. The other half is marketing psychology. Which of these headlines is more compelling to a cash flow sensitive buyer? Price reduced to $575,000. Or seller offering Buydown. Get a 5% interest rate for your first year. For many buyers in a high-rate market, the second headline is far more powerful. A $25,000 price cut on a $600,000 home is nice, but it only reduces the monthly principal and interest payment by about $165. An interest rate that is 2% lower, however, reduces that same payment by over $600 in the first year. The Buydown addresses the buyer's single biggest pain point directly: the immediate monthly payment. It makes the unaffordable suddenly feel affordable. It gets buyers off the sidelines and into the house for a showing. It makes Maria's property stand out in a sea of listings that are all just competing on price. It's a sophisticated strategy that can result in a faster sale, for a higher net price, by transforming a negotiation about price into a conversation about affordability. So whether you're a buyer with a rising income, a rate watcher betting on a future refinance, or a seller looking for a creative edge in a tough market, the 2-to-1 buydown offers a level of flexibility that a simple price negotiation can't match. It's not just about changing the numbers on a contract. It's about restructuring the financial reality of a home purchase to fit a specific timeline and a specific set of circumstances. It's a scalpel, not a sledgehammer, designed to solve very particular problems for very particular people. Of course, with any powerful tool, there are potential risks and complexities that you absolutely must understand before moving forward. So let's talk about what happens when that scalpel slips. Because the biggest mistake you can make is confusing a lower initial payment with true long-term affordability. They are not the same thing. And the gap between them is where financial dreams can turn into nightmares. This brings us to the first and most infamous risk of a 2-to-1 buydown, the payment shock. Imagine this. You buy your dream home for $500,000 with a 7% interest rate. Your principal and interest payment would normally be about $3,326. But with a 2-to-1 buydown, your first year rate is 5%. Your payment is a much more comfortable $2,684. That's a savings of over $640 a month. You're thrilled. You furnish the house, maybe you buy a new car to go in the new garage, you start eating out a little more. You're not saving that $640. You're absorbing it into your new lifestyle. Your budget has expanded to fit the lower payment. Then year 2 arrives. The clock ticks forward. Your rate jumps to 6%. Now your payment is $2,997. It's a $300 increase. It's noticeable. You feel a little pinch. You cut back on a few things, but it's manageable. You tell yourself, it's okay, we can handle this. But you're still not saving that extra cash, and you're definitely not preparing for what comes next. And then the big one. The calendar flips to month 25. The buydown is over. The subsidy is gone. Your interest rate locks in at the full 7%, and your payment skyrockets to the original $3,326. From one month to the next, your housing cost just jumped by another $330. Compared to what you were paying just over a year ago, you are now paying $642 more every single month for the next 28 years. That is payment shock. It's not a gradual increase. It's a financial cliff. And if you haven't been meticulously planning for it, it can feel like a punch to the gut. Your budget, which was built around that year 1 payment, is now completely broken. Suddenly, the dream home feels like a financial prison. This is the #1 trap people fall into. They focus on the year 1 savings and treat it like a permanent reality, instead of what it really is. A temporary, rapidly expiring discount. Now, I know what you might be thinking. I'll just refinance before the rate hits the full 7%. I'll get a new lower rate and my payment will stay low forever. This is the second major risk, what I call the refinance mirage. Relying on a future refinance to save you from payment shock is one of the most dangerous gambles you can make in real estate. You are essentially betting your entire financial stability on a future event that is completely out of your control. Think about what needs to happen for a refinance to work in your favor. First, interest rates in the overall market have to be lower than your note rate. What if they're not? What if in 2 years rates are at 8%? Or 9%? Refinancing would actually make your payment higher. You're betting on the Federal Reserve and global economic trends, and let me tell you, not even the experts get that right consistently. Second, your personal financial situation has to be perfect. To get the best rates, you need a high credit score. What if you have a medical emergency in the next 2 years that dings your credit? What if you lose your job or decide to start your own business, changing your income on paper? Lenders look at your debt-to-income ratio. If you've taken on a car loan or have more credit card debt, you might not even qualify for a refinance at all. Third, your property value needs to hold steady or, ideally, increase. If the housing market takes a dip in your area and your home is suddenly worth less than what you owe on it, a situation known as being underwater, no lender is going to touch that refinance. You'll be completely stuck with your original loan and the full 7% rate. And finally, let's not forget, refinancing isn't free. You have to pay closing costs all over again. We're talking thousands of dollars for appraisals, title insurance, and lender fees. So even if rates do drop a little, the cost to refinance might wipe out any potential savings for years. The idea that a refinance is an easy escape hatch is a mirage in the desert. It looks real from a distance, but when you get there, you might find nothing but sand. You cannot build a 24-month financial plan on a foundation of pure hope. You must qualify for and be comfortable with the full unsubsidized mortgage payment from day one. If you can't, you are not ready for this loan. This leads us to the third and perhaps most subtle danger of the 2-to-1 buydown, the higher purchase price illusion. This is especially critical when the seller is the one paying for the buydown as an incentive. On the surface, it looks like a gift. The seller is giving you, say, $12,000 to lower your interest rate for 2 years. Amazing, right? But sellers are not charities. And that $12,000 has to come from somewhere. Often, that cost is simply baked into the purchase price of the home. A home that might have been listed for $500,000 is instead listed at $512,000 with a free buydown. The seller is still getting their target price, but you, the buyer, are now taking out a larger loan. You're financing an extra $12,000. Over 30 years at a 7% interest rate, that extra $12,000 will cost you over $28,700 in total payments. Let me say that again. You are potentially paying an extra $28,000 over the life of your loan, in exchange for a $12,000 discount that only lasts for 2 years. You've traded a short-term benefit for a much larger long-term cost. It's a classic case of seeing the shiny object in front of you without realizing it's attached to a much heavier chain. This is why you have to be so careful. When you see a seller offering a buydown, you must ask yourself and your real estate agent a critical question. Is this a genuine concession, or is the price of the home inflated to cover it? Could you negotiate a $12,000 price reduction instead of the buydown? Because a price reduction is permanent. It lowers your loan amount forever. It lowers your monthly payment forever. It reduces the total interest you pay over 30 years. A buydown is a temporary fix. It's a band-aid, while a price reduction is surgery. So you have the payment shock cliff, the refinance mirage, and the inflated purchase price trap. These are the three horsemen of the 2-to-1 buydown apocalypse. They can work in concert to create a truly devastating financial situation where you've overpaid for a home and are stuck with a payment you can no longer afford, with no escape route in sight. So we've stared into the abyss. We've seen the traps and the potential for disaster. It sounds terrifying, right? It sounds like something you should run away from as fast as you can. But what if I told you that for every single one of these risks, there's a specific strategy, a financial shield you can put in place to protect yourself? What if you could get all the upside of the buydown with almost none of the downside? Well, you can. And that's exactly what we're going to break down next. How to bulletproof your 2-to-1 buydown strategy and turn this risky tool into your ultimate advantage. The first step to bulletproofing your buydown is a mindset shift. You must stop looking at the 2-to-1 buydown as a way to afford a house you otherwise couldn't. That is a trap. That is financial quicksand. Instead, you need to view it as a strategic tool to optimize your cash flow for the first 24 months of homeownership. The foundation of this entire strategy, the single most important rule you must follow, is what I call the Year 3 stress test. It's simple, non-negotiable, and it will save you from making a catastrophic mistake. Before you even think about making an offer, you must ask yourself one question. Can I comfortably, without question, afford the full unsubsidized mortgage payment at the permanent note rate? That's the payment you'll have in month 25 and every month after that for the life of the loan, assuming you don't refinance. If the answer is anything other than an immediate, confident yes, you walk away. You stop. You do not pass go. You do not sign that contract. Let me be crystal clear. If you need the Year 1 and Year 2 discounts to qualify for the loan or to make the monthly payment manageable, you are not using a 2-to-1 buydown. The 2-to-1 buydown is using you. You are gambling your home on the hope that interest rates will fall within a specific 24-month window. That's not a strategy, it's a prayer. A real strategy is built on a foundation of certainty. By qualifying and budgeting for the full final payment from day one, you completely eliminate the risk of payment shock. The buydown is no longer a crutch you need to stand. It becomes a jetpack that propels you forward. The discounted payments for the first 2 years are now a pure bonus. It's extra cash. It's a windfall you can use to build your emergency fund, invest, furnish the house, or even make extra principal payments on the mortgage itself. You've taken the biggest risk, the Year 3 payment jump, and neutralized it before you even have the keys in your hand. That is step 1. Step 2 is creating your refinance action plan. Hope is not a plan. You need to know with mathematical certainty At what point it makes sense to refinance out of your buy-down loan. This isn't about feelings or headlines. It's about numbers. Your action plan has two key components: your trigger rate and your break-even point. Your trigger rate is the new interest rate that would make a refinance financially worthwhile. A common rule of thumb is that a 1% drop in rates is a good time to look at refinancing. But we're going to be more precise. You need to call a lender and find out the approximate closing costs for a refinance on your loan amount. Let's say it's $5,000. Now, you calculate the monthly savings. If your original note rate was 7% and you can now get a 6% fixed-rate loan, what's the difference in the monthly payment? Let's say it's $300 a month. Now you do the simple math. Divide the closing costs by the monthly savings. $5,000 divided by $300 is about 16.6. This means it would take you just under 17 months to break even on the cost of the refinance. After that, every single month is pure savings in your pocket. Knowing this number, your break-even point is powerful. It transforms the decision from a vague "should I refinance now?" into a clear, data-driven choice. Your refinance action plan might look like this. If 30-year fixed rates drop to 6% or lower, and the break-even period is under 24 months, I will initiate a refinance. You've defined your exit strategy before you even entered the deal. But this is where the bulletproofing gets even better, and where we uncover a secret benefit of the 2-to-1 buydown that almost nobody talks about. What happens to all that money the seller put into the buydown account if you refinance early? Let's say the seller paid $12,000 to fund your buydown. You live in the house for 15 months enjoying the lower payments, and then rates drop. You execute your refinance action plan. You've only used, say, $7,000 of that $12,000 buydown fund. What happens to the remaining $5,000? Does it go back to the seller? No. Does the lender keep it? Absolutely not. That remaining $5,000 is applied directly as a principal reduction to your loan balance. Let me say that again. The leftover money from the seller's concession is paid directly onto your mortgage, instantly reducing what you owe and instantly increasing your equity. This is an incredible, game-changing feature. It means that refinancing early doesn't cause you to lose the buydown benefit. It just transforms the remaining benefit from a monthly payment subsidy into a lump sum equity boost. Think about the power of this. You get lower payments for over a year, and then when you refinance, you get a bonus check of thousands of dollars paid directly towards your debt. This completely flips the script. The risk isn't about refinancing too early. The risk is not having a plan to take advantage of this feature. This leftover funds hack turns your buydown into a two-stage rocket. Stage 1 is the initial cash flow savings. Stage 2 is the principal reduction bonus upon refinancing. This brings us to the final layer of our bulletproof strategy: the negotiation itself. The entire premise of a successful buydown hinges on one critical fact. You, the buyer, should not be paying for it. The buydown fee must be paid by the seller as a seller concession. This is not just a nice-to-have. It's a fundamental requirement of this strategy. You are not asking for a price reduction. You are asking for a seller credit to be used specifically to fund the temporary buydown. Why is this so advantageous? For the seller, it's often a much more attractive proposition than a straight price cut. A $12,000 price cut is a $12,000 loss, period. But a $12,000 credit for a buydown? That keeps the home's official sales price higher, which looks better for them and for the neighborhood comps. It's a marketing tool. They can advertise a below-market interest rate for the first 2 years, which is far more enticing to buyers than a slightly lower price. You are framing your offer not as you needing help, but as you providing the seller with a sophisticated marketing tool to get their house sold. By getting the seller to pay for the buydown, you have effectively de-risked the entire financial transaction from your side. Let's recap the fortress you've just built. First, you've stress-tested your budget against the full permanent payment so you know you're safe no matter what. Second, you have a predefined refinance action plan, so you know exactly when to pull the trigger to lock in long-term savings. Third, you understand that any unused buydown funds come directly back to you as an equity bonus when you refinance. And fourth, you've negotiated for the seller to pay the entire cost of setting this up. You've received a massive reduction in your monthly payments for up to 2 years, giving you incredible financial flexibility for free. You have a clear plan to convert this short-term advantage into a permanent one, and you have a built-in bonus waiting for you that reduces your loan principal. You've taken a tool that many people fear or misuse and have engineered it into a multi-layered system that only provides upside. But knowing how to structure the strategy is one thing. Knowing how to actually negotiate it and get the seller to say yes is another skill entirely. And that's the art we need to master next. So let's pull back the curtain on the negotiation. Most people think of it as a battle, a zero-sum game where one person wins and the other loses. But the masters of negotiation, the ones who consistently get what they want, they know the truth. It's not about winning a fight. It's about solving a puzzle. And the seller is holding the most important piece. To get them to hand it over, you first have to understand the world from their side of the closing table. Every seller at their core wants two things: the highest possible price for their home, and a fast, clean, hassle-free closing. That's it. Everything else is just noise. Their biggest fears are the exact opposite. A lowball offer that insults them, and a deal that gets tangled in complications and falls apart weeks later, forcing them to put the house back on the market, looking like damaged goods. Your job is not to go in with a demand. Your job is to present yourself as the solution to their deepest fears. The 2-to-1 buydown isn't a handout you're asking for. It is the very tool that allows you to be the perfect buyer they've been dreaming of. It's the key that unlocks their two primary desires. Think about the typical negotiation. A buyer wants a lower price. Let's say a house is listed at $500,000. The buyer offers $480,000. The seller is instantly put on the defensive. Their number, their valuation has been challenged. Their ego is bruised. So they counter at $495,000. The buyer comes back at $485,000. This painful dance continues until they either meet somewhere in the middle, with both parties feeling a little bit like they lost, or the deal collapses over a few $1,000s. The buydown strategy flips this entire script on its head. You are going to change the conversation from price to payment, from a painful reduction to a strategic investment. Here's how you frame it. Your real estate agent, who must be your champion in this process, doesn't call the seller's agent and say, "My client wants you to pay for a buydown." That's a losing proposition. Instead, the conversation sounds something like this. "We have a fantastic offer for your clients on their $500,000 property. We are prepared to come in at full asking price. We love the home, we're pre-approved, and we're ready to move quickly. To make this work at this price point, we need the seller to contribute 2%, or $10,000, towards a temporary interest rate buydown at closing. This allows us to comfortably manage the payments for the first 2 years, and makes us an incredibly strong buyer for their home at their price." Let's dissect the psychology of that statement. You led with the ultimate prize, full asking price. You immediately gave the seller exactly what they wanted most. You eliminated their primary fear. Before they could even process the ask, you handed them the win. You also reinforced your strength as a buyer, pre-approved, ready to move quickly. You are positioning yourself not as a problem but as the answer. The request for the buydown is then framed not as a discount, but as a facilitator. It's the mechanism that enables you to give them their full price. You are connecting the dots for them. You're saying, "Help me help you." Now let's look at the math from the seller's perspective, because this is the logical hammer you use to seal the deal. Let's use that $500,000 house again. A 2% buydown costs the seller $10,000. If you had instead tried to negotiate the price down, you likely would have aimed for a $20,000 or $25,000 reduction. Even if you settled at a $15,000 price cut, the seller is still $5,000 better off by giving you the buydown concession. You need to have your agent explicitly state this. "Look, my buyers could have come in with an offer of $485,000, but they know the value of your property. Instead, they're choosing to honor your asking price. In exchange, they're asking for a $10,000 contribution. This puts an extra $5,000 or $10,000 directly into your client's pocket compared to a standard price negotiation, and it gets them a solid, committed buyer. It's a win-win. This is an incredibly powerful argument because it's built on undeniable logic. You're not asking for a favor. You are presenting a financially superior alternative for the seller. You're transforming yourself from a typical buyer trying to chisel down the price into a creative partner, offering a better financial outcome. This strategy is especially potent in specific market conditions. If a house has been sitting on the market for 45 or 60 days, the seller is starting to get nervous. They're feeling the pressure. Their biggest fear is having to do a major price reduction. A price drop is a public admission that they were overpriced. It signals weakness to other buyers and can trigger a cascade of lowball offers. Your offer with the buydown concession is their lifeline. It's a way for them to move the property without a public price cut. They get to save face, protect their investment, and close the deal. You're giving them an elegant exit. The same applies to new construction. Builders are often extremely reluctant to lower the base price of their homes. Why? Because it sets a new comp, or comparable sale price, for the entire neighborhood. If they sell a home to you for $480,000, the next buyer who comes along will see that public record and demand the same price. It devalues their entire inventory. However, builders are often very willing to offer incentives or closing costs contributions. A buy-down concession fits perfectly into this category. It doesn't affect the official sales price of the home. They get to record the sale at $500,000, protecting their comps, while still giving you the financial help you need. They do it all the time. You just have to know to ask for it in this specific way. Now, you have to be prepared for objections. The seller's agent might be old school. They might not immediately understand the concept. This is where your agent's preparation is critical. Your agent should have a simple one-page PDF ready to email over, explaining exactly how a 2-to-1 buy-down works with a clear example. They need to be an educator, not just a messenger. If the seller counters with, "Just lower your offer price by $10,000 instead," your response has to be ready. Your agent should reply, "We appreciate the counter, but a $10,000 price reduction only saves my clients about $60 a month on their payment. The $10,000 buy-down saves them over $500 a month in the first year." It's the immediate cash flow relief that makes them confident in their ability to purchase your home at this price. The payment matters more than the price. You are re-anchoring the conversation to the real-world problem you're solving: the monthly payment. You're showing them that their counteroffer, while seemingly logical, doesn't actually solve the core issue. It's not about being difficult. It's about being clear on what makes the deal possible. The final piece of this puzzle is embedding the request properly in the official purchase offer. This isn't a handshake deal. It needs to be written into the contract. There's a specific section in most standard real estate contracts for seller concessions or seller contributions to closing costs. Your agent will write in the specific language something to the effect of, "Seller to credit buyer $10,000 or 2% of the purchase price at closing for the buyer's recurring and non-recurring closing costs, including the cost of a temporary interest rate buy-down." This legal language ensures everything is above board, and that the funds are handled correctly by the title company or closing attorney. By mastering this approach, you shift the entire dynamic. You're no longer a supplicant asking for a discount. You are a strategic partner, armed with a creative solution that benefits everyone. You've done the math, you understand the psychology, and you've framed the offer in a way that is almost impossible to refuse because it aligns perfectly with the seller's own self-interest. You've made saying yes the smartest possible move for them to make. But getting the yes is only one part of the equation. Now the money is on the table, and the clock starts ticking towards closing. What happens behind the scenes? How does the lender actually set up this buy-down account? And more importantly, what are the hidden pitfalls during the underwriting process that could jeopardize the entire deal, and that buy-down you fought so hard to win? Let's break down the mechanics. The process starts with a simple concept: an escrow account. Think of it as a special savings account, locked in a vault, that your lender sets up specifically for this buy-down. The money to fund it, that $6, $7, maybe $10,000 or more, doesn't come from the lender. It comes from the seller or sometimes the builder. At the closing table, this lump sum is transferred from the seller's proceeds directly into this dedicated escrow account. It's your money in the sense that it's for your benefit, but you can't touch it. The lender acts as the trustee, the guardian of these funds. Each month for those first 24 months when your mortgage payment is due, the lender performs a little bit of magic. They take your reduced payment, your year 1 or year 2 amount, and then they reach into that escrow account, pull out the difference, and combine it to make the full mortgage payment to the investor who actually owns your loan. It's a seamless, automated process. You just pay your lower amount, and the system handles the rest. But this elegant solution hides a brutal, unforgiving gauntlet you must pass through first: underwriting. This is where more buy-down deals die than anywhere else. The single biggest landmine, the one that blows up deals every single day, is a fundamental misunderstanding of how you qualify for the loan. Let me be crystal clear, because this one point could save you thousands of dollars and immeasurable heartbreak. You do not qualify for the mortgage based on the artificially low year 1 payment. I'll say it again. The underwriter, the person with the final say, almost universally ignores that tempting, beautiful, low monthly payment you'll have for the first 12 months. They qualify you based on the full, unsubsidized, note rate payment. The PITI, principal, interest, taxes, and insurance, that you will be paying in year 3 and beyond. Imagine this scenario. You've found your dream home. The note rate is 7%. With a 2-to-1 buydown, your year 1 rate is 5%, and your monthly principal and interest payment is, say, $2,500. You've run the numbers. Your debt-to-income ratio, or DTI, looks great with that payment. You're confident. You submit your application. Days turn into a week of silence. Then you get the call from your loan officer. Their voice is tense. The underwriter has run the numbers not at the 5% rate, but at the full 7% note rate. At that rate, your payment isn't $2,500. It's closer to $3,300. And with that higher payment, your debt-to-income ratio is no longer the comfortable 38% you calculated. It's 46%, and the lender's absolute maximum is 45%. The underwriter has issued a denial. The deal is dead. All because of that one critical misunderstanding. You were celebrating a payment you didn't even need to qualify for. The buydown is a payment assistance tool. It is not a qualification tool. Think of it as a bonus you get after you've already proven you can handle the full cost of admission. This is the first gatekeeper in the underwriting process, and it's the most ruthless. But let's say you clear that hurdle. Your DTI works even with the full note rate payment. You're not out of the woods yet. Now we have to talk about the money itself, the seller's contribution. Lenders don't just let sellers throw unlimited cash at a deal. They have very specific, rigid rules called seller concession limits. These limits are a percentage of the home's purchase price, and they vary dramatically depending on your loan type. If you're getting a conventional loan and putting down less than 10%, the seller can only contribute a maximum of 3% of the sales price towards your costs, including the buydown. Put down 10% to 25%, and that limit goes up to 6%. If you're using an FHA loan, the limit is a flat 6% regardless of down payment. For VA loans, it's 4%. Now, why does this matter so much? Because the cost of the buydown itself counts against that limit. Let's run the numbers. You're buying a $400,000 house with a conventional loan and putting 5% down. Your seller concession limit is 3%, which is $12,000. The seller has generously agreed to pay for a 2-to-1 buydown, which costs $8,000. They also agreed to pay $5,000 of your other closing costs. You add it up. $8,000 for the buydown plus $5,000 for closing costs equals $13,000. But wait, your limit is $12,000. You are $1,000 over the maximum allowed seller concession. The underwriter will flag this immediately. The deal cannot close as structured. You now have to scramble, trying to either renegotiate with the seller, who might be unwilling to change the purchase price, or come up with an extra $1,000 out of your own pocket that you hadn't budgeted for. Failing to understand these concession limits is like trying to pour 10 gallons of water into a 5-gallon bucket. The underwriter is there to make sure not a single drop spills over. Next up in this minefield is the appraisal. The appraisal is the independent valuation of the property to ensure it's worth what you're paying for it. In a normal transaction, a low appraisal is a problem. In a buydown transaction, it can be a catastrophe. Why? Because those seller concession limits we just talked about are typically calculated on the lesser of the sales price or the appraised value. Let's go back to our $400,000 home purchase. You have a deal for a 6% seller credit totaling $24,000, which is fantastic. It covers the buydown and all your closing costs. Everyone is happy. Then the appraisal comes back. The appraiser values the home at only $380,000. Suddenly, that 6% seller credit is no longer calculated on $400,000. It's now 6% of the new lower value of $380,000. Your total allowed seller credit just plummeted from $24,000 to $22,800. You've instantly lost $1,200 in concessions. If your buydown and closing costs were already pushing that $24,000 limit, you now have a shortfall. The appraisal didn't just lower the home's value. It actively shrank the pool of money available to fund your buydown. The underwriter will see this discrepancy, adjust the numbers, and send the file back, forcing you into another frantic, last-minute negotiation or a search for extra cash. Finally, there's the ghost in the machine, the hidden variable that even savvy buyers and agents miss: lender overlays. Overlays are extra rules and restrictions that an individual lender adds on top of the baseline guidelines set by Fannie Mae, Freddie Mac, or the FHA. You might find a lender that, for example, has an overlay stating they won't allow a 2-to-1 buydown on investment properties, even though standard guidelines might permit it. Or maybe they have a stricter DTI limit for loans with buydowns. Or perhaps they require a higher credit score. The most dangerous part about overlays is that they are unique to each lender. There's no universal rulebook. You could have a deal that is perfectly acceptable under FHA guidelines, get it denied by lender A because of an overlay, and then take the exact same file to lender B and have it approved without a single issue. This is why working with a loan officer who is an expert in buydowns is not just a luxury, it's a necessity. They need to know not only the federal guidelines but the specific internal rulebook of the lender they work for. Without that expertise, you're flying blind through a storm of invisible rules, and the underwriter is the final arbiter who will enforce every single one of them, seen and unseen. So you see, getting that buydown from negotiation to the closing table is a journey fraught with peril. It's about proving you can afford the full payment, ensuring the seller's contribution fits inside a very specific box, praying the appraisal supports the value, and navigating the secret rules of your specific lender. But if you can successfully navigate this gauntlet, you'll see the proof on your final closing disclosure document. It will be listed right there as a credit, a lump sum from the seller, funding your buydown escrow account and paving the way for 2 years of lower payments. But what happens if your plans change? What if you decide to sell the house or refinance your mortgage before those 24 months are up? What happens to all that money left sitting in the buydown account? Does the seller get it back? Does the lender keep it? Or does it belong to you? The answer to that question is one of the most overlooked and most valuable aspects of a 2-to-1 buydown. And the answer is, it's yours. That money belongs to you. It doesn't evaporate. It doesn't go back to the seller. And the lender absolutely does not get to keep it as a little bonus. This is, without a doubt, the most misunderstood and powerful feature of a legitimate 2-to-1 buydown program. Let's break down exactly how this works, because understanding this concept transforms the 2-to-1 buydown from a simple temporary relief tool into a sophisticated and flexible financial strategy. First, you have to change how you think about that buydown fund. It's not a fee. It's not a gift to the bank. It's a special type of escrow account, often called a custodial account. The seller or builder deposits a lump sum of money into this account at closing. That account is legally earmarked for one purpose and one purpose only: to supplement your monthly mortgage payments according to the February 1st schedule. The lender is just the custodian of the funds, disbursing them each month on your behalf. The money is, for all intents and purposes, your money, held in trust to be used for your benefit. So, what happens if you interrupt that 2-year schedule? This is where it gets really interesting. There are 2 primary ways this happens. You either refinance your mortgage or you sell the house. Let's tackle the most common scenario people are banking on right now: refinancing. Imagine you get a 2-to-1 buydown today. Your permanent note rate is 7.5%. In year 1, you're paying 5.5%. In year 2, you're paying 6.5%. The total cost of this buydown paid by the seller was, let's say, $15,000, all sitting in that custodial account. Now let's fast forward 18 months. You're 6 months into your second year. You've been making payments at that 6.5% rate. Over the last year and a half, you've used up, let's say, $10,000 of the buydown funds. That means there is still $5,000 sitting in that account, waiting to be used for the final 6 months of the buydown period. But then the magic happens. Interest rates drop significantly. Your loan officer calls and says, "Hey, we can get you into a new 30-year fixed rate at 5.9%. It's time to refinance." You jump at the chance. You go through the process and you close on your new refinance loan. What happens to that $5,000 left in the buydown account from your old loan? This is the beautiful part. That $5,000 is applied directly to the principal balance of your new loan as a one-time lump sum payment. It's called a principal curtailment. So if your new refinanced loan amount was supposed to be $400,000, it instantly becomes $395,000 on day 1. That leftover money doesn't vanish. It's injected directly into your home equity. Think about the power of that. You got 18 months of significantly reduced mortgage payments, and then the unused portion of the seller's contribution gives you a massive head start on your new loan. You're already $5,000 ahead of schedule. That single payment could shave years off your mortgage and save you tens of thousands of dollars in interest over the life of the new loan. It completely removes the fear of losing the buy-down benefit if you refinance early. You don't lose it. You simply convert the remaining benefit from a monthly payment subsidy into instant, cold, hard equity. It's a win-win. Now let's look at the second scenario. You sell the house. Life happens. Maybe you get a job offer in another state, or your family grows and you need a bigger place. Let's use the same example. You have a loan with a 2-to-1 buy-down. $15,000 was put into the custodial account. But this time you sell the house after just 13 months. You've just started the second year of the buy-down. During that first year, you used, let's say, $9,000 of the buy-down funds to enjoy that 2% rate reduction. That means there is still $6,000 sitting in the account, untouched. When you sell your home, the buyer's money comes in to pay off your existing mortgage. The title company requests a payoff amount from your lender. That payoff amount is your remaining mortgage balance, minus the $6,000 in your buy-down account. So if you owed $400,000 on your mortgage, the lender would effectively use that $6,000 to pay the loan down to $394,000, and that becomes the official payoff amount. What does this mean for you? It means that when the sale closes, you walk away with an extra $6,000 in your pocket. The money that would have gone to the bank to pay off that portion of the loan goes directly to you as part of your sale proceeds. Again, the money is not lost. It follows you. Whether you refinance or sell, the unused portion of the seller-paid buy-down fund comes directly back to you, either in the form of a principal reduction on a new loan or as cash in your pocket from a sale. This is a critical safety net. It means you can take advantage of the lower payments today without being terrified that you're locked in, or that you'll forfeit the seller's contribution if your plans change. Now, there is a crucial piece of advice here, and you need to listen closely. While this is the standard operating procedure for almost all conventional loans backed by Fannie Mae and Freddie Mac, as well as government-backed loans like FHA and VA, you must confirm the specifics with your lender. Some lenders, though it's rare, might have their own unique rules or overlays. When you are discussing a 2-to-1 buy-down with a loan officer, you need to ask this exact question. What is your policy regarding the remaining funds in the buy-down's custodial account if I sell the property or refinance the loan before the buy-down period ends? Get the answer clearly. A good loan officer will immediately confirm that the funds are applied to the principal. If they hesitate or don't know the answer, that's a red flag. This is fundamental knowledge for anyone offering this product. This single piece of information, that the money is yours and it follows you, should completely reframe how you view the 2-to-1 buy-down. It's not just a short-term gimmick to get you in the door. It is a flexible financial instrument that provides immediate cash flow relief with a built-in safety net that protects the seller's contribution for your benefit, no matter what happens in the next 2 years. It's a way to get a lower payment now with a plan to refinance later, knowing that any unused funds will give you a powerful head start on that future loan. It's about reducing risk while maximizing opportunity. So now that we've uncovered this hidden superpower of the 2-to-1 buy-down, the question becomes, is it the right move for you? We've explored how it works, who pays for it, the math behind it, and what happens if your plans change. It's time to put it all together. Is this strategy a genius move for navigating a high-interest rate market? Or is it a complicated trap with hidden dangers? In our final part, we'll lay out the ultimate verdict, weighing the definitive pros against the critical cons, so you can decide once and for all if a 2-to-1 buy-down is the key to unlocking your dream home. So we've arrived at the final crucial question, the ultimate showdown. Is the 2-to-1 buy-down mortgage a golden ticket to homeownership, a brilliant strategy to beat the current market? Or is it a complicated trap, a ticking time bomb set to go off in 24 months, leaving you in financial ruin? The truth, as it often is, lies somewhere in between. And where you fall on that spectrum depends entirely on your preparation, your discipline, and your unflinching honesty about your own financial situation. Let's start with the case for the 2-to-1 buy-down. Why are so many people talking about it? Because when it works beautifully. The most powerful pro, the one that gets all the headlines, is immediate and significant cash flow relief. In a world of high interest rates and even higher home prices, seeing a monthly payment that's hundreds, maybe even $1,000 lower for the first year, feels like a miracle. This isn't just a number on a page. It's tangible breathing room. It's the money you can use to buy furniture for your empty living room, to cover the unexpected costs of moving, or to build up an emergency fund, something every new homeowner desperately needs. That first year in a new home is notoriously expensive. The buy-down acts as a financial cushion, absorbing some of that initial shock and stress. Second, it provides a psychological and financial on-ramp to your full mortgage payment. Think of it like easing into a cold swimming pool instead of cannonballing into the deep end. The full pity payment on a new home can be jarring. The buydown gives you a 2-year period to acclimate. Year 1, you adjust to the lowest payment. Year 2, you adjust to a higher intermediate payment. By the time you reach the full note rate in year 3, you've had 24 months to adapt your budget, your spending habits, and hopefully your income to this new reality. It's a graduated approach that can make the transition to homeownership feel much more manageable. Third, in the right market, a 2-to-1 buydown is an incredible negotiation tool. Imagine you're a buyer in a market where homes are sitting for a little longer. A seller might be reluctant to drop their asking price by $20,000 because it sets a new lower precedent for the neighborhood. But they might be very willing to offer a $20,000 credit for a February 1st buydown. For them, it's the same net result. But for you, the buyer, it can be far more powerful. A price drop might save you $100 a month. A buydown could save you $700 a month for the first year. It allows you to ask for a concession that directly impacts your immediate quality of life, making an otherwise out-of-reach property suddenly feel affordable. And finally, there's the best-case scenario, the home run. You use the buydown as a bridge to a better future. The entire premise of the buydown is based on the hope that interest rates will drop. If within that first or second year, mortgage rates fall significantly, you can refinance out of your original loan and into a new lower fixed-rate mortgage for the next 30 years. In this scenario, you never even face the full, higher note rate. You enjoyed 2 years of discounted payments, and then locked in an even better rate for the long haul. The buydown served its purpose perfectly, getting you into the house so you could wait for the right moment to strike. But, and this is one of the biggest buts in modern finance, for every one of these pros, there is a dark corresponding con, a risk you absolutely cannot ignore. The number one danger, the monster under the bed, is payment shock. We have to be brutally honest about this. The jump from your year 2 payment to your final, full payment in month 25 can be catastrophic if you are not prepared. It's not a gentle slope, it's a cliff. Your payment could suddenly increase by $500, $600, $700 or more, overnight. If your financial situation hasn't improved, or worse, if it has declined, that single payment increase can be the difference between comfort and foreclosure. Budgeting for the year 1 payment is a rookie mistake. Living a lifestyle based on the year 2 payment is a dangerous gamble. The only payment that truly matters, the one you must be able to afford from day 1, is the final undiscounted payment. Second, and this is a critical mental shift you must make, a buydown is not a discount on the price of your home. The total amount you owe the bank does not change. The seller or builder is essentially prepaying some of your interest for you. That money, the buydown fee, is held in an escrow account and disbursed to the lender each month. While it feels like a discount, it's more accurately described as a financing subsidy. Very often, the cost of this subsidy is already baked into the asking price of the home. A builder offering a massive buydown incentive might have inflated the price of the house to cover it. Always ask yourself, would I rather have the buydown, or would I rather have that same amount of money knocked off the sales price, reducing my loan principal forever? Third, the dream of refinancing is just that, a dream. It is not a guarantee. Betting your financial future on the ability to refinance is one of the riskiest strategies a homebuyer can take. What if interest rates don't go down? What if they go up? We've seen it happen. What if your personal financial situation changes? Maybe you lose a job, your credit score takes a hit, or you take on other debt. Any of these things could disqualify you from refinancing. If you enter a 2-to-1 buydown with the assumption that you'll just refi your way out of the final payment, you are setting a potential trap for yourself. You must plan to pay the full note rate and view refinancing as a lucky bonus, not a core strategy. So, who is the 2-to-1 buydown really for? And who should run in the other direction? This is an excellent tool for a buyer with a high degree of certainty about their future income growth. Think of a medical resident who knows their salary will triple upon finishing their residency in 2 years. Or a tech employee with a clear promotion and bonus structure. For these individuals, the final payment isn't scary because they have a clear, predictable path to earning significantly more money. They can comfortably afford the final payment, but the initial savings allow them to manage their cash flow during their lower earning years. For them, it's a strategic cash flow management tool. It can also work for a disciplined buyer who already qualifies for and can comfortably afford the full final payment today. They don't need the buydown to afford the house, but they choose to use it to their advantage. They take the monthly savings from the first 2 years and, instead of spending it, they use it to aggressively pay down other high-interest debt, invest it, or build a massive home emergency fund. They use the Buydown as a financial accelerator, not a crutch. Now, who should avoid it at all costs? Anyone who is stretching to buy a home and is using that low year one payment to justify the purchase. If you look at the final, full pity payment and feel a knot in your stomach if you think, I can't afford that right now, but I'm sure I'll get a raise by then, you must walk away. That is a recipe for disaster. The Buydown is not magic. It does not make an unaffordable house affordable. It simply postpones the inevitable. So here is your final verdict, your ultimate checklist. Before you even consider signing a 2-to-1 Buydown agreement, you must be able to answer a resounding yes to these 3 questions. 1. Looking at the absolute worst-case scenario, the full undiscounted principal and interest payment at the final note rate. Can my current budget handle that number today, without causing extreme financial stress? 2. Is my income stable, and do I have a realistic, not just hopeful, reason to expect it to increase over the next 24 months? And 3. Am I mentally and financially prepared to handle the full payment in month 25, even if I am completely unable to refinance? A 2-to-1 Buydown is a specialized financial instrument. It's a scalpel, not a sledgehammer. In the hands of a prepared, disciplined, and well-informed buyer, it can skillfully carve out a path to a dream home in a challenging market. But in the hands of someone who is unprepared, over-leveraged, or simply too optimistic, it can cause devastating financial harm. The power is now in your hands. You have the knowledge. The choice is yours. Make it wisely.